So as we start 2017, we're really doing it in the backdrop of two very material political events that occurred in the latter part of 2016. And I'm really talking about the UK's decision to exit the European Union, as well as the surprise election of Donald Trump. Now both events, whilst they've occurred, we still don't actually know the real impact they're going to have on markets. Now in the context of those surprise events, we really have global economies performing very well. I mean, the US continues to generate robust growth, and we saw the US Federal Reserve raise interest rates for the first time in 2016 in December, and that was well anticipated. But what came with that in a post-Trump election environment was really a much more aggressive, or a slightly more aggressive interest rate outlook than the market had been anticipating. So the US Federal Reserve currently anticipate to increase interest rates 3 times in 2017. In addition to that, Europe has continued to surprise on the upside, and if we look back over 2016, really European economic strength was far higher than we in the market generally were anticipating, and that's a very, very positive sign. As we look across the global economic landscape, China, in our view, is the exception. We continue to expect or be far more sanguine about that economy, and whilst GDP economic growth continues to be around that 6.6, 6.7% level, we think that the risk there is to the downside, especially as the government continues to look at ways to extract itself, both from the financial and fiscal stimulus that it's poured into that economy in recent years, and to find the economy onto a more self-sustaining basis. Well, the final quarter of 2016 really saw a material change from what were otherwise relatively flat period through 2016. And the catalyst for this really was the election of Trump in the US, as market participants thought that for the first time the US government will have a clear mandate to actually push through structural and fiscal changes that Trump had talked about. Now, equity markets and commodity markets were very strong short-term beneficiaries for that in that final quarter. And similarly, we saw the US dollar take on a very strong renewed strength, up about 5.5% over that period, which, as we know, for the Australian dollar, meant a corresponding loss of that amount. Similarly, we saw a large amount of selling in interest rate sensitive investments, and most particularly fixed income investments, as markets continued to realise that the lower interest rate environment that we've been in for many, many years is no longer likely to be the case moving forward. So with these large moves in markets, the question is, what's the outlook from here? We continue to remain aware that markets are fully priced, and pricing in a lot of these future beneficial expectations, both in earnings potential as well as this positive economic environment that we sit within. In that light, we continue to hold larger amounts of cash than we normally would in anticipation that some of these exogenous risks that might come to bear provide a better buying opportunity. A good opportunity that came along in the latter part of 2016 was the ability to buy into a large part of an A-grade regional office building, which came about because an institutional client was a forced seller. We bought that at a material discount to its net tangible assets, about 15% discount, and that, in simple terms, allowed it to have a running yield of a little over 10%. So being flexible and open to a whole variety of opportunities gives us the capacity to add value even when certain market pricing is not as attractive.